Welcome to Property118.com. My name's Mark Alexander and I'm joined today by property investor and independent financial advisor Jason Howard. Jason, I believe there's a new product come into the market that's just been launched, which is equity release for landlords. Can you explain for the benefit of our viewers what that is?
Yeah, we're partly very surprised to see it happen. The equity release market in the UK for non-landlords has been a growing market, but recently a new provider has come onto the marketplace that for clients with above the age of 55, up to 5 properties, can release money from their portfolio to either repay debt or to use, which they don't repay, it's just stayed on the estate as a debt.
So this is really aimed presumably at people who've paid off their mortgages, don't necessarily want to sell their properties, but want to draw some money out of them?
Yeah, it could be one of two strategies, Mark. You could have clients with multiple portfolios where they want to reduce the outgoings on debt today.
Mm-hmm.
So, for instance, if a client had a property with 200,000 with 60,000 of debt on, paying 300 to 400 a month, and they wanted that 300 to 400 a month for themselves, they could use the equity release style product to repay the debt, and then the yields are theirs.
Mm-hmm.
Or it could be, in your example, it could be actually to release money out to do other things with.
Okay, so on an equity release mortgage, you still get charged the interest, but you don't actually physically pay it out to your bank account every month, do you?
Absolutely right. I mean, one of the best terminologies I believe for it is an American terminology called reverse mortgage.
Mm-hmm.
So it's the opposite to how we used to know it. So effectively, the individual would not be paying the monthly payments, but the debt would be accrued on the estate.
Right.
And often we find that if we do the planning with the families, this could be used effectively as part of legacy planning.
Yeah, actually I was thinking about that because if the property is going up by, let's say, 5% a year, so it's doubling in 15 years in value, and you're paying a similar sort of rate on a mortgage, in real terms, your debt's actually standing still, isn't it?
Absolutely right. And money can be released and put into trust for benefits of children out of the estate for tax purposes. So we find it a very creative way of raising money and increasing people's yields from a day-to-day point of view.
Yeah. Now, I know on equity release, a lot of people think, or a lot of children and beneficiaries don't want their parents spending their money, but at the end of the day, my personal view is it's their money. Do you come across that kind of thing with your parents?
In conventional worlds, we definitely have come across it, and we often advise all the family members who are important decision-making are present. But I'd imagine with the property landlord it'd be slightly different because it won't be all the client's wealth, because it will be a number of properties. So absolutely, but children's reaction can be very strange. Some say spend it and enjoy it, and some are very worried about their own future.
Right, so typical market for this product then would be somebody with a portfolio with very low debt or no debt that either wants to stop paying the mortgage payments and have the interest rolled up, or to draw out equity presumably.
Absolutely right.
And how does age affect that, Jason?
Well, the minimum age is 55, but the way this type of product works is the older you get, the lender's prepared to release more money, because the reality is you're likely to be getting closer to death.
Right, okay, so a 70-year-old is going to be able to borrow a lot more on an unencumbered portfolio than a 55-year-old.
Absolutely right.
Okay, excellent.
And this could be viewed, I believe, as another form of pension planning for clients and buy-to-let portfolios.
Absolutely, because if I look at myself, I'm in my early 40s. By the time I'm 70, my portfolio values hopefully will have grown substantially. They'll have certainly at least doubled and maybe quadrupled by then, but my debts are going to still be the same. So it could actually be an opportunity as an exit route.
It's a fantastic exit route, and remember, it's a debt situation, so the tax liabilities are zero when taking the debt out.
Right, and presumably, even though you're not paying that mortgage interest on a monthly basis, it's still accruing, so it could still be set off against your tax.
100%.
So a very, very tax efficient way of funding your lifestyle in retirement.
Indeed.
Excellent. Thank you very much for your time, Jason, and thank you for joining us at Property118.com. Hope you found that useful.